Investing is
knowing how to value a business,
research and timing,
psychological endeavor.
Investing without knowing what you're looking for is like running through a dynamite factory with a burning match.
There's a very, very dangerous jungle out there. How do I successfully cross the jungle?
There are thousands of different approaches to investing.
There's no formula anybody can give you. It's not like the Colonel's secret recipe.
If you're a self-starter and you work really hard, you can make a difference.
What knocks people out is the risk of ruin. In other words, it's that one time that gets you. In the early 80s, I made one of the biggest bets of my career, and I couldn't have been more wrong. I lost money for me, I lost money for my clients. I was so broke that I had to borrow $4,000 from my dad in order to pay for my family bills. And this was a very painful experience. And yet, it was probably one of the best experiences that happened to me because it changed my way of thinking. There's always a path. You don't know what the path is. And then you will, along the way, run into obstacles. And you don't know what those obstacles are, and you do not know how you're going to get around those obstacles. Your goal is to keep moving in the direction, and you will find the best path. I don't think that I'm in any way intrinsically better or more capable than most people. I think my approach to pain, mistakes, and weaknesses is a differentiating characteristic. To learn from the pain, to accept the realities, and to then engineer strategies that take me through it are things that I think almost anybody could adopt. But you discover along the way, you find the way. I'm Ray Dalio. I'm the founder of Bridgewater Associates, who took it from a 2-bedroom apartment to being the largest hedge fund in the world. I'm a global macro investor. I'm a student of history, patterns, and change. Changes in the overall environment, typically brought about by monetary policy changes that affect everything. They affect the interest rates, and through the interest rates and the tightness of money, they affect asset prices, they affect growth rates, they affect everything. That's macro investing. When it comes to investing, I think that there's kind of a lateral creative thinking process that is going on in my mind. My mind works in a certain way. Now, I don't know how much of that's genetic, how much of that it's environmental, but my dad was a jazz musician. He played woodwinds, clarinet, flute, sax. There's a certain vibe that comes from jazz, which has this improvisation to it. And I think that that played a role. Back then, I used to do jobs. I would deliver papers, shovel driveways from snow, and then I caddied. And so when I was caddying in the 1960s, the stock market was hot. Everybody was talking about stocks. And so the people I was caddying with would talk about stocks. I got into stocks. I took my caddying money. I would earn $6 a bag. I'd carry 2 bags. And when I got 50 bucks, I would put it into the markets. And I got hooked on the game. My first investment was the only company that I ever heard of that was selling for less than $5 a share. That was my investment criteria. Because I figured I could buy more shares, and if it went up, I'd make more money. Of course, that was a naive, stupid strategy, but I got lucky. The company was about to go broke, and some other company acquired it, and it tripled. And so I figured, this game is easy, and I like the game. But of course, you know, I learned with time, this game is anything but easy. So I graduated high school in 1967, and then 1968, the Beatles went to India to learn meditation, and then I decided that I was going to learn transcendental meditation in New York. Brought my little flowers and all that, and I learned meditation. And that was transformative because it has given me the equanimity, the centeredness, mental centeredness, so that whatever's coming at me, I can calmly approach. For example, one of my first lessons in macro investing happened on August 15th, 1971. I was clerking on the floor of the stock exchange, and I was following the markets. And then on Sunday night, Richard Nixon gets on the television and announces that no longer would he let you turn in your paper money for gold.
I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets.
Back then, gold was considered money in the world, and that dollars, paper money, was considered like a check that you could turn in for gold. The United States started to print a lot of money to pay for the Vietnam War, social programs, and so on. And it started to run out of gold. In other words, on August 15th, 1971, money as we knew it ceased to exist. And I walked onto the stock exchange floor the next morning, and I thought it was going to go down a lot because I understood what was happening. And it went up a lot, the most in decades. And I was shocked. And so I did research, and I found that the exact same thing happened on March 5th, 1933 with Roosevelt, and that printing of money and the making money loosely available was then the reason the stock market went up, because really the value of money went down. And so that was an epiphany. It made me a macro investor. And I had a realization. The same thing happens over and over again throughout history. And so one has to understand the cause-effect relationships. So I needed to go back and study periods like the Great Depression and so on to really understand history beyond my lifetime, before my lifetime, in order to understand what I was dealing with. And out of that, I formed one of my first investing principles. Reality works as reality works, and you have to know how it really works. And so by knowing those cause-effect relationships, I could see it as a perpetual motion machine. And I don't mean it just a physical machine, but I mean every dimension. What a person is like, what they think, what their strengths and weaknesses is, how they work together with other people, how changes in monetary policy or changes in inventiveness and all of those things. They are all cause-effect relationships that create a fairly complex machine. And I realized that the only way that I could succeed was understanding how reality works as a machine. And that way of thinking made my career and my life work a whole lot better. I went from clerking on the floor of the stock exchange to Harvard Business School. I graduated in 1973, the year of the oil shock.
1973 dramatized U.S. dependence on foreign oil.
Stock market went down a lot, commodities went up a lot. And in my summer job, I had worked as an assistant to the director of commodities, worrying about prices of things like fuel, corn, soybeans, and just about everything. And then I went to another firm, Shearson Hayden Stone. I was in charge of institutional commodities, which basically meant hedging. I was rowdy and at the time, and I, New Year's Eve, got into a fight with a boss. We had too much to drink, and it ended up where I decked him, and I also did some other rowdy things, and it was clear to them that I wasn't necessarily the best employee and the model employee in the way that they wanted, and clear to me that, doing things on my own might be a better path. So I got fired, and then I found that clients of this firm, they wanted to continue to get my input, and so I provided my input and I played markets, and that was the beginning of Bridgewater. As I said, I was dealing with commodity hedging, and then in the 70s, McDonald's became a client of ours, and I also had the largest chicken producer in the country as a client of ours, and McDonald's wanted to make Chicken McNuggets, but was worried because of the volatility in the markets that if they set a price for those Chicken McNuggets and the price changed, that they would have to change the menu price and there would be a problem. I'm dealing with the mechanics of how do you make a chicken, and then at the same time, we have the printing of a lot of money because they go off the gold standard, and then you have the oil shock of 1973. Oil prices rise, inflation prices rise, and that swamps everything. Changes interest rates, changes everything. And that's why I had to go to macro as well as micro in order to be able to deal with that. And it's a good example of how mechanics work. Okay, so they want a stable price. And then the mechanics of a chicken is that there's the price of the chick, but most of the cost of the chicken is in the feed, the corn and the meal, soybean meal that you feed to the chicken, and it grows. And I realized that what we could do is buy those ingredients forward in the futures market by buying the corn and the feed. And therefore, this chicken producer, by being able to hedge in that way, could offer McDonald's the fixed price so that they would then be able to not have the risk of the menu price. And so that's what I did, and that's how Chicken McNuggets first got its pricing and came into existence in the volatile markets. And I think it's a good example of the mechanics, cause effect. You understand how it works, and you can put things together to achieve results. Back then, I started to realize as the company grew that I needed to communicate effectively what I was doing. So I got in the habit of writing down my principles. It wasn't a habit, it was a necessity, because I need a game plan. In other words, I needed decision rules to be clear. So if I'm going to make a decision in the markets, okay, here I am. Let me write that down and let me see if it would have worked in the past. And then I wrote down a bunch of those rules, and then I realized it was true of every aspect of my life. Rather than to just make decisions, I was then looking at how I made decisions. And then I found that I could take those principles which were written in now, and I could put them into equations. So algorithms, as we call them now. And then with that, I know how my decision-making process would have worked through, literally, I do it through hundreds of years. Then I was able to build analytical systems, very much like a computer chess system. We'd reflect off of each other. So let me give you an example of a couple of variables plugged into the system. There was a commodity index, which was a good short-term indicator of inflation, and initial claims for unemployment, which was a good short-term indicator of economic strength. And when I would put those two together in a certain way, I could get a weekly pulse of economic growth and inflation, and I knew that that affected monetary policy. So you could see each one of these was a barometer that was a pulse to be able then to put those together so that I would get a picture and then convert that into a decision rule. And then, of course, I built those out over a period of time, and it became very big and complex because it covered all different countries, all different markets. And that was one of the really early primitive ones that began the process. I love to play the markets. People like my input on the markets. They'll pay me for doing that. And it looked to me like it was working well. I had no idea what was to come. So between starting Bridgewater in 1975 and 1982, I started to build a family and things grew. And in 1979 and 1980, when there was really tight money policy, I had calculated that American banks had lent a lot more money to foreign countries, that those countries were going to be able to pay back, and that there was going to be a big debt crisis. And then in August 1982, Mexico defaulted on its debts. And that began a series of defaults. And at that time, I got a lot of attention for anticipating this, and I was asked to testify to Congress, and I thought that there was going to be an economic crisis that was going to result from this big debt crisis. And I couldn't have been more wrong. August 1982, when Mexico defaulted, was the exact bottom in the stock market. And I lost money for me, I lost money for my clients. I was so broke that I had to borrow $4,000 from my dad in order to pay for my family bills. And it was a moment there where, I didn't know whether I was going to have to go back, put on a tie, get on the train, commute to Wall Street and do a Wall Street job or not. And this was a very painful experience. And yet it really taught me something, and it taught me a principle, gave me a principle. And the principle is pain plus reflection equals progress. I think that sometimes we don't realize that pain is a great teacher, and we just say, I don't want pain. But sometimes we learn through pain. And so to reflect on those painful moments, because they tell me how the world works, I then started to ask myself, how do I know I'm right? And it changed my whole approach to decision making. So in that moment in 1982, I calmly reflected on my circumstances to find the way to have the greatest life possible without those unacceptable risks of crashing. It seemed like there's a jungle out there, and I could be on the safe side. Or I can choose to cross this jungle that is a very, very dangerous jungle to then achieve great success. And then I figure, how do I successfully cross the jungle? And I realized that the way to do it was to find people who were on the mission with me who could see things differently from me. Because back in 1982, I made a mistake of betting too much on my own opinions. And I realized I needed to open my mind up to other people's perspectives to make better decisions and make it safely through the jungle. I'm a professional mistake maker, meaning I would say probably 1/3 of the decisions that I make in the markets is probably wrong. And I find it very odd, but very typical, that people emphasize arguing that they are right more than the curiosity of whether they could be wrong, which could make their decisions so much better. So the smartest people I've ever met in my life, and I've had the opportunity to meet the smartest people in the world, the most successful people in the world, are the people who think that way, are the curiosity and looking at how do they learn, how do they get another perspective, how do they challenge their thinking. You have to be humble. Success is achieved when you get smart to a certain level and then you gain humility so that you can take it in and then you can move on to that other level. And so, out of this realization, I decided to build Bridgewater into an idea meritocracy. Idea meritocracy means the best ideas win out from wherever they come from, in which the goals are meaningful work and meaningful relationships. And a passion to be on the mission to succeed and then have meaningful relationships like you're in it together. And to do that through radical truthfulness and radical transparency. In other words, not political correctness. To be able to talk about anything and challenge each other in a non-hierarchical way. For example, if you find out that you're not good at something, is that a good thing or is that a bad thing? It's a good thing, because if you're not good at something, you could also work with somebody who's good at that thing you're not so good at, and you're going to be better together. You can deal with it. If you don't recognize that you're not good at something, then you're going to continue to have that problem. And I would say that probably for a third of the people who've come, maybe more, 40%, it's not for them. It's too difficult. They may have bruised egos. And for the others, they can't work anywhere else because of the ability to challenge anything, to say anything, to see everything, and to have that idea of meritocracy, which means that not everybody makes the cut. Not everybody gets a trophy. It's like an intellectual Navy SEALs or something. It is that kind of culture. And so that culture is not for everyone, but it's been essential to our success. So that experience was an enlightening experience. And really from that point until now, I mean, here we are, 40 years later, everything has gone by and large well. So I reimagined our culture, and the next step was to reimagine our investment strategy. A few months ago, I was cleaning out my office, and I came across an artifact from an earlier time at Bridgewater, when the epiphany hit me. And I saw that back then, I had made a note to myself, and it said, diversification, the holy grail. I realized that I had to deal with risk. Somehow, I wanted the upside of great results, and I didn't want the downside, and I had to figure it out. And that was the realization I could have the upside with a whole lot less downside by diversifying well, which is basically the realization that I can't be confident in any one bet. I realized that, I drew that, and then I wrote on top of that, the Holy Grail. Meaning, okay, pursue that, do that. If I can get that, I will achieve success. Since early in my career, I wrote down and examined the criteria I used for making virtually all of my decisions. Over time, these turned into decision rules that helped me understand cause-effect relationships in the markets. So to engineer this diversification, I developed another set of systems based on these decision rules. As I was building all these decision rules and seeing how each of those decision rules worked, I would get what I call profit curves from those decision rules. A decision rule is how to deal with the market. If you buy stocks or you buy the S&P 500, then you get the movement of the stock market. That's its return stream. If you then make a decision to sell and to buy and so on, that active decision is a separate return stream that is different. And you can separate those return streams. And so I had collected, like hundreds of these return streams. And I realized that I didn't need hundreds of these return streams. I just needed the best 15 or 50. So I went through all of those, and I then decided I wanted the top 5% of those return streams. And I wanted to separate alpha from beta. So I should explain alpha from beta. You can think of beta as the performance of an index of the market as a whole, such as the NASDAQ or the S&P 500. Whereas alpha is the performance that comes from making active decisions to buy or sell to try to do better than the market. So I took my decades of notes and looked back through time at the cause-effect relationships and wanted to put together the best portfolio of alphas and betas. So imagine this. I'm using the stock market because it's the common thing. Investors in the stock market who then would pick better stocks and worse stocks. Because I was in all these different markets, I could take the alphas from all those different markets and package them as a pure alpha position. A pure alpha portfolio is simply a bunch of uncorrelated bets, so that the bets diversify each other to produce the Holy Grail, to produce the reduction of risk without the reduction of returns. What that means is it has 15 return streams, so think of it like 15 investments, and it has risk, the standard deviation on the return, and it just shows on that scribble that if you go from 1, 2, 3, 4, 5, all the way out to 15, and they have 60% correlation, you don't reduce much risk. And then it goes from 60 to 40 to 20 to 0% correlation. And you see on that graph how that it eliminates 80% of the risk. So the holy grail of investing is to have 15 good, uncorrelated return streams, uncorrelated investments. If you can do that, you will reduce the risk by about 80% while keeping that returns the same. Then you can engineer that. You can inject some amount of leverage in that to be able to have a very good return relative to the risk. So that was one of the keys, the diversification. Then the writing down decision rules that were then converted in algorithms that are doing the back testing. Learning from mistakes, all of that, those were the ingredients. Diversification, systemization, all of that was essential for that improvement. So over the period of Pure Alpha, we've made more money for our clients than any other hedge fund in existence from the time I started till the time I passed along Bridgewater. We made positive returns for our clients in 28 out of the last 32 years with no big bad years. And then as I started to then personally accumulate more money and think about, well, what would happen beyond me in terms of the generations and so on, I started to realize that, alpha is a talent war. It's like you go down to a poker table and somebody's going to walk away with more chips from somebody else who's going to lose the chips. It's a zero-sum game. And I can't necessarily know who will be producing the best alphas. I remember very clearly thinking, how do I structure a timeless and universal portfolio that is going to maintain wealth, increase wealth, and do it without any guidance from me or anyone else for generations to come? In 1991, I created the portfolio of Pure Alpha. And in 1996, I created the portfolio of Pure Beta, which I call all weather, because it's not subject to the environmental risk. If I go back 100 years or more, I can tell you that if the environment changes in a certain way, growth and inflation change in a certain way, that those markets will change in ways that I understand in relationship to those things. Therefore, I can construct a portfolio of betas that's going to be balanced and not dependent on alphas. A portfolio that would work through time for the next 100 years based on the intrinsic characteristics. Like, for example, if you know that inflation and economic growth accelerates, you know interest rates are going to rise and you don't want to be in bonds, and so on. So to be operating, to know those intrinsic characteristics and create a portfolio led me to create the all-weather portfolio, which is a portfolio of betas. You have to look at the intrinsic determinants of those markets. So for example, when there's a lot of inflation volatility relative to growth, then what you're going to see is negative correlations between stocks and bonds. And when there's a lot of growth volatility and relative to inflation, then you're going to see positive correlations. So for all weather, we broke the market environments into 4 types based on its big influences, growth and inflation, which could go up or down. And if I have 25% of my risk in each of those 4 quadrants, I'll have a balanced portfolio. For example, recently, a lot of tech companies didn't have much in the way of current earnings. They had high growth expectations. And with those high growth expectations and no earnings, because of the structure of those, we call those long duration assets because they will pay off in the long run. They're not going to pay off in the short run. When interest rates went up, because of that, they were very sensitive to interest rate changes. And so you see that reflected in all of the markets now, right? The things that went down a lot are of that nature. The promise of future earnings through future inventiveness. No, that doesn't count right now as much as it did in the past. So you could see that dynamic. That's a timeless and universal dynamic that happens through time. By building it all weather, not based on the correlations that existed in the past, but instead based on the intrinsic balance that is achieved by having some assets that do well in an inflationary period and an equal number of assets that do well in a disinflationary period, or some assets that do well in a high growth environment and some assets that do well in a low growth environment. Structurally, by having that 4 quadrant perspective, there is structural diversification that comes from that. So if you want to know the key to our success over such a long period of time is that we survived. Thinking about if you lose 50% of your money, you have to make 100% to get back. And then so many firms along the way have had that time where they have gotten whacked and lost. People come to me all the time asking, what should I invest in, or what does the future hold? And my answer to the question often surprises them. Sometimes they like it, and sometimes they don't. I think of the saying, I would rather give a man the ability to fish than to give him the fish. And for that reason, I want to show the cause-effect relationships, and I want to show the principles that I use to fish, so to speak, so that people could make their own decisions independently. I'd like to give a little bit of advice to the average investor or investors out there. And I want to say that it all comes down to the basics. Like most things in life, they all come down to the basics. You need to think of it as having a few different portfolios that each protect you against different levels of risk. So the first layer of your portfolio is how do you get that element of security? How much money do I have to meet my needs if I was to lose my job? And I would want to make sure that that was secure. You have to cover your fundamentals for a long period of time, and don't worry about the upside so much. Worry about the downside that you've got that covered. You lose your job, whatever it is, I'm financially fine. How many days, weeks, months, years do you have that allows you to build that portfolio? And then you have to think, what amount is that? Because you've got to put it somewhere. You have to put it in an investment. And so you start thinking, what are those best investments? And basically, assume the worst. Assume that after inflation and taxes and everything, fell in half. So to have twice as much money, I think, as you need. And when you've got that, you've got freedom and you've got power. And then you say, how do I play that game? And the way that you play the game is first to know what you know and know what you don't know. Be humble about that. To succeed in the markets is more difficult than to succeed in the Olympics. There are more people who are trying to do it. They've got more money in terms of their resources. But would you say, I'm going to go compete against the Olympics? So you start with that humility and then realize the most common mistake of investing, to think that the investments that did well in the past are good investments rather than more expensive investments. So what you always see is that the common investor will buy at the highs and then sell at the lows because they'll think, oh, I'm scared and that's a bad investment because it didn't do well. And so that's the common mistake. And then seek that diversification. That's the most important thing. Be careful. If you're going to bet, bet. But don't bet in amounts that are going to blow through what the amount of money that you're going to need. And see, how do you bet? Once you start that, then you're on the journey. Then I recommend that you write down your criteria. Have a journey like I've had the journey of, you think about, what would that rule have been? How would that have worked in the past? And then build a strategy for investing that you know how it would have worked in the past, and then you build that knowledge in that way. But how do you figure out what did and didn't work in the past? Let me show you. In investing, looking back at history is one of the most valuable tools we have. It's like Mark Twain said, history rhymes. It doesn't necessarily repeat itself, but it rhymes. And what he really means by that, or the mechanics of that, is there are things that happen over and over again through history, and there are even cycles that make them happen. And then there is an evolutionary development of understanding, so that you can look at these cycles happening around this uptrend. By understanding these cause-effect relationships, one can be one step ahead of what's going to happen. Three things that caught my attention that are now happening that never happened in our lifetimes before, but happened many times through history, are first, the production of a lot of debt because we want to spend more than we're earning. And where do we get that money from? We print the money. In other words, central banks print it and they buy that debt. These credit and debt cycles that drive spending, drive economic activity, and drive market movements. They've happened over and over again for basically the same reasons. You go back through history, and it happened really for thousands of years. The idea in the Old Testament, there's a cycle of about 50 years, and then there's the year of Jubilee where it's forgiven, is the same basic dynamics of what a bank is. They don't have as much money in the bank as they promise, and then you have a bank collapse. So history has shown you can't do too much of that without having a disaster. I call item number 2 internal conflict. There is a great conflict now that's becoming almost dysfunctional in terms of how we are with each other. That doesn't mean we don't have good qualities or good places in this country, but that notion of populism of the left and populism of the right and fighting, people will fight over their opinions. It's a win at all cost type of environment, not a how do we compromise in the way that democracy is supposed to work in order to achieve the common good. There's a threat to that. The closest period that you can find in the world was the 1930s period for the same reason. You have an economic problem, and with that economic problem and large wealth gaps, then there's fighting between the groups, and you have that. And you see that 4 democracies in the 1930s chose to be autocracies because of that populism and so on. So you never experienced it in my lifetime. I'm 73 years old. We haven't experienced that. And number 3 is external conflict caused by struggles to control the world order. There is a great powers conflict in the world where 2 comparable powers, the United States and China, are in this competition or almost warlike setting. There are 5 kinds of wars. There's a trade war, a technology war, a geopolitical influence war, a capital and economic war, and a military war. We are in the first four. We are in those other wars. We're not yet in a military war. But there is a military war also going on with Russia, but contained to be within the Ukraine. And there are greater risks. More countries have nuclear weapons and so on and so forth. So the risk is greater. The United States is not as dominant as it was by any of the measures before. And so that creates this particular struggle. I can't tell you whether we're going to go over the brink or not, but I would say that the odds of some kind of irreconcilable differences internally or irreconcilable differences externally are higher than they have been in our lifetimes before. So we're entering a period that is most analogous to the 1930 to 45 period in terms of financially, levels of debt, internal conflicts, external conflicts. When these three forces come together, it can lead to terrible times with bad economic conditions and often a new world order. And the last time that happened was 1945. We began a new world order, an American world order where the United States is the dominant power. And then you have a period of peace and prosperity because no one wants to fight the dominant world power and so on. And then power shifts, and then there's a great power conflict. While it's scary, nothing is predestined. So tracking how these trends continue or shift will give you the tools on your journey. The same basic mechanics, cause-effect relationship applies to macro, micro, all dimensions of life. We have our personal experiences. We have all of those challenges with things we don't wish for, things that we wish never happened. But they are a function of how reality works, and we have to accept those and know how to deal with them well. I think my approach to pain, mistakes, and weaknesses is a differentiating characteristic so that to learn from the pain, to accept the realities, and to then engineer strategies that take me through it are things that just about anybody could adopt. I've had some very painful experiences that I never could have imagined happening. What came to mind is the serenity prayer, which is, God, give me the serenity to accept that which I cannot change, the courage to change that which I can, and the wisdom to know the difference. There's a life arc that we all go through which has such obstacles, and it pays to reflect on it. I just put out a journal, and one of the guided journal exercises is to look how a typical life cycle works and know where you are in that life cycle. And if you go through it, you can check off, like we all do the same things practically. You're born a certain age, you graduate school, then you develop a relationship, maybe you get married, maybe you have kids, and to know where you are in that life cycle realistically, and then start to imagine where you will be in 10 years and where the people that you care about the most, maybe it's your parents, maybe it's your children, where will they be in 10 years? And to start to put that in perspective and how it works. It's all mechanics. Everything has these cause-effect relationships, and just to look at reality that way, to adapt, to be wise, and to navigate it well. And there's no getting around the fact that you have to be strong, because the key to success is knowing how to struggle well.